Nothing we say is investment advice. Please pause on all 3 pages of this disclaimer and read it. Greetings, Algo artisans. It is 4:26 p.m. EST Tuesday. I've got Natasha here, and this is the Trading for Beginners sessions. Natasha, you joined us in the last few weeks, and you really are showing some interest, and you're learning fast, learning quickly, and we have high hopes for you, of course. It's been very fun working with you so far. It's just fun to have students who not only understand the material and pick it up, but who want to. You know, a lot of people come in and they expect trading to be this, just, hey, this is easy and I click buttons and I make money. So, obviously, if that were the case, then we'd all be trillionaires, or actually we'd all be broke. Regardless, I'm very happy to have you here. And
Thank you.
how was your last week as far as, studying, learning, going through courses? How do you feel?
I think I am getting there slowly, Nick. I'm just trying to understand the terminology of things. So I think I would be a swing trader.
Okay.
I think that's what feels more comfortable for me. And I've been trying to understand TradingView. I've got a basic account on TradingView, and now I'm just trying to look at a formula that will work for me, or that I can test, do some back testing. So it's been a bit slow because I just want to understand all the terminology and what it means. So yeah, and just going back over some information that I've read before, because I'm just trying to reread things very carefully, just to make sure it kind of clicks in my brain.
Well, there's nothing wrong with measure twice and cut once.
Mm-hmm.
So, taking the time to make sure we understand something is key, right? And I won't release any details here, but the conversation we had prior to hitting the play button, you definitely know how to grab onto and handle very complex things. So, that said, is there any terminology? By the way, before I ask this question, a swing trader, for the audience, if you watched last week's show or if you watch any of my work, you probably would know that a swing trader is somebody who trades on the 4-hour time frame, maybe, where you're taking, depending on which market you're in, you're taking a trade or two a week. You're able to see trades form slowly. Like you might see on Monday or Tuesday that a trade's going to happen, and then it happens Tuesday night, and you make your entry, and then you hold it for a day or maybe 8 hours, maybe 18 hours, and then you're out. And it's a way for people to trade who have jobs or have other responsibilities that take up most of their day. And so that I just wanted to clarify that for those who didn't have that bit of terminology. Speaking of terminology, is there any, or are there any questions you might have? Are there any terms that you might like some clarification?
Yes, I wanted to understand the difference between Forex, crypto, and stocks, because I am interested in stocks. I'm interested in crypto and Forex. Are there pros and cons to each asset? Do you need a level of understanding for each asset? I was attracted to crypto, but I don't think I fully understand it, and the difference between all these meme coins and government-backed coins. So yeah, I think that's where I just need to kind of clear the pathway on that one.
Sure. Well, let's make this easy. See if I can just give us a visual aid here. What it does matter. It is important for us to understand our asset class. So where's my screen? Oops. Let's undo that, and let's add a screen for presentation. Give me one moment. Okay. Here we are. So the way to look at this, and what really matters in the end, is an asset class going to work for trading, for your swing trading, right? And pretty much any asset class will do. You want some volatility, and you want it to be as consistent as possible. Now, cryptocurrency is not very consistent. You'll have maybe a year of a lot of volatility, and then you'll have like not very much volatility for a year. There's nothing to do, very few trades. So to have consistent income from swing trading cryptocurrency, that's not something that I've experienced, which is why I moved over to Forex. Okay, so everybody knows what stocks are. And as far as what cryptos are, I can kind of touch on that. But I will start with Forex so that we can understand what it is. It's a very simple concept. It's just foreign exchange. It's what Forex stands for. And I actually have family who kind of pioneered this market. And that's another story for another day. But I'll just read this out. Forex, short for foreign exchange, or FX, is the global decentralized marketplace where national currencies are bought, sold, and exchanged against one another. It is the largest and most liquid financial market in the world, processing over $7 trillion in daily trading volume, far outpacing equity or bond markets. Okay, so how Forex works. Currencies are always traded in pairs, such as the euro versus the dollar, the pound versus the yen. When you execute a trade, you're simultaneously buying one currency while selling another. So your base currency is the first currency listed in the pair, which is, in this case, the EUR. The quote currency is in the USD. So what that means, let's move over to a chart. And I will share this tab. And if you'll allow me a moment, I will make this make a little bit more sense because it looks crazy right now. Let's put on the euro versus the dollar. This is actually my presentation chart, so let's move away from that. Give me one moment. Okay. So we'll delete all this stuff. And there are a few indicators on the chart here, but this is the euro versus the dollar. Your base currency is the euro, and it might be hard to see on this screen, but up in the top corner, that says USD up here. That means this is euros quoted in dollars. So right now, the euro is $1.15 or $1.15.7. So the value of these currencies go up and down. They fluctuate constantly. And in Forex, you are trading very large positions, and this is made possible by leverage. Okay, so you're borrowing a lot of money for a very short time and a very small fee to trade in this market. So you're betting on, say, the euro going up in a fraction of a penny as compared to the dollar, or down, right? So this is actually from a currency, from a fundamental standpoint, it is a very good way to understand cryptocurrency as well, which we're not going to talk about right now. We're going to stick with Forex for the moment. So foreign exchange markets work because you have, for example, the reason so much money clears, the reason it is the most liquid market in the world is because large companies have very large bills to settle. So you might have, say, a British company that needs to pay a European company, and they need to pay that European company in euros. However, in order to have those kinds of funds ready, they'll be in FX reserves for a period of time. And it might be that the pound has been gaining in strength or is about to gain in strength against the euro. And when you have $80,000, that can make a difference in your balance sheet. Or even if you have $80 million, right? So if you have which is a massive bill, but let's say you are some kind of investment company and you have $80 million on the balance sheet in cash, in FX reserves and foreign exchange reserves, then you are able to see that the pound might be going up 1% in the next week, and you have to have those FX reserves over that week. then 1% of $80 million is something like is it $800,000, something like that, or pounds really in this case. That is £1 million almost, if my math is correct, and so that is very substantial. So which money you decide to hold your currency in is going to make a difference on the balance sheet of, in that particular case, nearly 7 figures. So large companies will shift their FX reserves over to whichever currency is performing in an optimal way as compared to whichever currency they might need to pay their bills. So this is essentially money markets. And that's my understanding is most of the movement in Forex markets is this. The rest of it is speculation. But in a sense, that is also speculation, right? That's why these markets effectively exist. So what we do as traders is we piggyback, right? So because that market exists and we are now allowed to participate in said market, we just have to borrow a lot of money every time we trade in order for it to make any sense.
Oh, okay.
So go ahead.
Sorry, I was just going to ask. This is where I just need a bit of clarity. I've noticed, so I'm looking at 3 types, 3 or 4 currencies at the moment. Pounds, I look at dollars, I look at Barbadian dollars, and then I look at euros. Those are the currencies that I'm dealing with at the moment for my professional life.
Okay.
Yes. Yeah. When they say a currency's weaker or stronger, could you explain that? Because I noticed at one point in the past, the pound was parity with the euro. Now I think it's about 84 pence to €1. So essentially that's weaker. And I don't know if that's, I see that as a bad thing because I have to deal with it and I have to convert all the time. But could you just explain when a currency is weaker? Because sometimes if a currency is weaker, it can yield positive outcome, and then if a currency is too strong, it can yield negative outcomes on the market. If that makes sense.
Oh, it does. And many people don't understand that. Many people think a strong currency is good and a weak currency is bad, but you want a weak currency when you are exporting.
Okay.
So people who have a strong currency will come to buy your product because their currency is strong in comparison to yours. So a weak currency allows you to manufacture things at a cheaper rate as compared to the people who are buying them from you.
Oh, so does that translate to if I have a weaker currency and let's say I'm making tea bags, somebody who buys it from me would essentially pay more if they're having to convert the currency into pounds, or how does that work? Sorry. What matters is that they will be able to purchase more of them from you. Oh, got it.
Because their purchasing power is stronger. So, for example, if you have a company that moves their manufacturing to a country that has very cheap labor.
Yes.
Right? This is a similar concept. You now are the cheap labor.
Yeah. Got it.
It's just it's just fractionally cheaper. So you will experience this not as necessarily a large standard of living change over a short period of time. You'll merely experience this as somebody buying 1,200 tea bags instead of perhaps 1,000.
Understood.
Because they can afford it. Because you're at a better rate than your competitors who have more expensive currencies. Their inputs are higher.
Mm-hmm. That makes sense.
But a weak currency also can contribute to other problems within borders, where you start to see inflation within your own borders. So this is all a give and take. Everything in the end, wealth is wealth and money is not. So these are two different things. Wealth and money are two separate things. Wealth and currency, I should say, because there's money and then there's currency. Money is gold or silver or, hard currency, if you will. Currency itself is just these numbers that we deal with. Our dollars, our pounds, these are mostly electronic. I think 97 to 99% of dollars in the world are electronic. They don't exist as paper. They're just numbers that a computer says exist.
Yes.
So currency is merely a medium of exchange. So when your medium of exchange becomes stronger than, say, somebody else's medium of exchange, you can buy more of their products. They can sell more of them to you. And for a time, that's going to benefit them. It will benefit people who are manufacturers and exporters because they can sell more of their products. But over time, their economy will have issues with inflation, which is what's happening to Japan as we speak. So if I were to go over to the USD JPY chart.
Yeah.
And if you've been following my shows, you'll know that I've not been touching the Japanese yen pairs because of all the manipulation that's going on. And this manipulation is not a bad or illegal thing. It's Japan trying to protect their currency. But you'll notice that if I zoom out,
yes,
you'll see going back to 2021, their currency was at about 100 yen to the dollar right at the COVID crash. This might be hard to see on the chart here because of all the gobbledygook. So let's do this. Let's go monthly. That way we don't have a lot of noise on the chart. In 2011, it was 74 yen to the dollar. Now it is 159, double, right? So the Japanese economy has experienced a lot of inflation, and this has to do with, this is actually something that matters. Have you heard me explain, or really V the Gorilla explain, the yen carry trade?
I've been listening to it, but I don't really understand the history of it. So I understand that Japan has been, kind of teetering on the edge, but I didn't understand the history of it because I was actually looking into the history of Japan, and they had there's this theory called the miracle method. After the Second World War, they kind of pulled themselves up, and they created a very prosperous economy. So in my mind, I've always thought that Japan is a prosperous country, and now discovering, well, it's not so much. And the cost of living has increased. I've had a couple of friends who have gone to Japan, who went to Japan, and they said it was really expensive against a euro and against the dollar, when they were converting it. The cost of living was expensive. But could you possibly just kind of recap how Japan's got to this stage?
I'll try to make it brief. So some of the biggest brains in the world are in Japan, and they have a very strong culture. So after World War II, they went to work, and deals were made with the US and other nations around the world. They became a manufacturing powerhouse, and they were on the cutting edge. And so the wealth that they produced, the real wealth, was staggering. They were able to, they had brilliant ideas. For example, I remember hearing a story where they would take our steel, or it might have been our ore, and then they would refine it on the ships on the way over to Japan. Like they're innovative, very, very smart people. I have a lot of respect for their culture, obviously. So yeah. That translated into true economic wealth. And of course, I imagine as part of the deal after World War II, their economy was very influenced, to put it lightly, by Western and in particular US powers. So they were allowed to sell vehicles in the US market. They made better vehicles and other products, many other products. They outpaced us in many ways. And then the Bank of Japan went ahead and started to lend out a lot of money. They made money very, very cheap. And people would ask for, the equivalent of $100,000 to buy a house, and they were given $300,000 at a very low rate. And so this huge bubble happened because of very cheap money. And for a time, their stock market was even bigger than the US stock market. I believe just the land, and it wasn't the entire country. I think it was just part of Tokyo. The land there was technically worth more than like all the land in the US. I mean, it was a blip, it was a very quick time. It was a panic up in valuation, but this is what happens when money gets cheap. And then that eventually ruptured. And because it's all you're doing is making money cheap at that point. Mm-hmm. And you have some very wealthy people over there, and they just are getting all these, they're able to buy a lot of assets. And for a time, the value of these assets has not caught up to how cheap the money is. So there's sort of the short window where people can use a very powerful currency and basically print it out of thin air and use it to buy things. Well, they also started using the Japanese yen once they made it cheap. Once they started producing their debt, they started issuing debt at very low interest rates, very cheap Japanese bonds, which of course, bonds are the other end of money, right? And so they started using that. They would print the debt, and then they would sell the debt for like US equities or real estate around the world or other investments, so that the issuers of debt in Japan were able to accumulate real assets that had a lot of value in exchange for very cheap debt that was printed effectively ad infinitum. So they started issuing this cheap debt, buying assets around the world. And once you continue to issue very cheap debt, you devalue your currency. And that's what you see on the chart right here. And so all of that cheap debt, buying equities around the world, is essentially, it's a liquidity solution for the equities markets, stock markets around the world, especially in the Western world. The liquidity solution is Japanese debt. And this is why you see the dollar rising against the yen. So that's the yen carry trade. Now, the way that debt works, and again, I don't want to get too far into this, but the way the debt works is when you issue new debt at higher rates, all of the debt that's already out there that has not yet matured then becomes worth a lot less on the secondary market. The secondary market is like, for example, I buy a 20-year bond at, let's just say, 5%. That's going to sell on the secondary market. I don't know what they sell for. I'm not a bond guy, but let's just say it's $100 bond. I'm just gonna make up numbers here, and I can sell it for like, $22 or something. And it's based on the yield and all the stuff. Well, when you issue new debt at a higher yield, it's going to be worth a lot more, and the existing debt out there is going to be worth a lot less. So what used to be $22 is now $18, and you have like trillions of dollars out there that take a 5 or 10% or more hit, and then all the money holding up all of the markets immediately contracts. Right. So you have basically, it's like somebody owns a house and they've got 20% down, and something happens, and now they're only have 15% down, and the bank's like, we need our other 5%. And you're like, I gave you 20%. So, well, your money isn't worth what it used to be. And if you can't come up with that 5%, then we're going to call in the loan and you're going to be kicked out of your house. Well, if the Japanese hike their rates, that's what's going to happen. Okay. So this is just the complex picture, and understanding it is fine. It's good to know for macro. It's good to understand if you are investing. As a trading channel, we're not quite as concerned with all of that. The only reason that it's useful to know such things is that at this particular time, the Bank of Japan and the US Bank are cooperating to keep the Japanese yen down. And when these things happen, you end up with these big, hard moves down, and there are many on a much lower time frame. Many more of these moves down that are not visible on this daily chart, because this chart goes back to the beginning of the year. Each one of these candlesticks is a day's worth of price action. If I were to zoom in, you would see a lot more of these moves, and they are impossible to trade. And this is why I'm not touching the end. So knowing all of this is helpful to understand from an investment standpoint what may happen in the future, and also which way the wind is blowing. You can get that just by looking at the chart. But what you don't understand without understanding those things is, if I were to zoom in here to say what is this, the 30-minute resolution. So this is a 30-minute chart. Each one of these candlesticks is 30 minutes. If you zoom in, you can see this is not fun to trade. Do you see all these wicks? This wick, that wick, this wick, right here, this here. Those will kill your trades. Every single one of those gets people out of their trades. So it's impossible to trade it. So knowing the history of all this is, okay, it's fine. It's interesting. It's fun. Like, I could just have said, don't touch Japanese yen until they figured it out. Right. And that would be what you need to know as far as trading. Like, hey, they're trying to keep the yen strong, and so they're doing these manipulations, and until those manipulations stop, it's going to be very difficult to trade the yen, so I'm going to stay away from yen pairs. Like, that 15-second sentence is a lot more useful than the entire explanation of the history of Japan and all. It's interesting to know these things, but if we're trying to get moving on trading, then knowing these things, while interesting, it's not quite the best use of your time, in a way. I don't know. It's hard for me to make that judgment call, because I know this and it does help me understand things. But if I were merely as a technical trader looking at the charts, and I mean, like, man, what is going on with this currency pair? Then I could have that explanation, or a very short explanation of, oh, they're trying to keep their currency a certain level, and so don't touch it until that's done. When will that be done? Well, we don't know yet. And that's really all we need to know. This is a big thing that, like, when I was trying to build a YouTube channel, really build this channel, which, I mean, look, I have 1,000 subscribers. This is not a very big YouTube channel. One of the people I was working with to kind of get it started was like, we'll talk about the news. I'm like, I don't care about the news. I'm a technical trader. I use the data on the charts to tell me what is going to happen. I do not need to know, what so-and-so in this economy, this minister, I don't care about that. It doesn't help me. Like, by the time that information comes out, it is too late to take the trade. I need to be able to interpret the charts based on the data, the mathematical data, and then make a choice to make that trade based on that data. The only useful thing about news is to know when not to trade.
Okay.
Because news is unpredictable. For example, what do we have? Last week, I think we had the FOMC. I'm looking on a different screen that you cannot see right now. Let's just use the PPI. So Thursday, August 13th, 8:30 EST was it's an inflation metric called the PPI. And if I were to go back to last Tuesday, let me fix my time here. And then let's apply it all. And we'll go to the 5-minute resolution. This is where each of these candlesticks is 5 minutes worth of price action. And I were to go to the 13th, you'll notice that right where that blue triangle is, that's just an indicator I was working on. It's an algo I was personally building, and I don't use it, but it's kind of cool. The point here is that you see how this candlestick right here, this red candlestick, I'll zoom in on it. It doesn't look like any normal candlestick. It's got these, if you've been watching candlesticks, you'll notice it's got this long tail, a long wick, and it's got this kind of weird body. That most candles do not look like this. And that tends to be some kind of market volatility. Anytime I see one of these, I know price tends to move in one particular direction afterwards. And this is just kind of a lot of It is not fun to trade. So if I were to put a white line there, and then I were to zoom in, you would see on a very low time frame what that price action looked like. And you'll see that it's hectic. So if you see here, price kind of moves up, jams down, and then it goes up. And I remember when the news came out too. Well, the PPI, the data that came out, was such that price should go up after this. But what did it do? It went down, and then it really went up hard. And in fact, it sparked huge, in the stock market, it sparked a huge move up. So why would it go down before it goes up? Because the news came out. It made it look like things should go up. So a lot of people went long and bet on the price going up, and their trade looked like this. Because I remember this happening. The trade looked like this, and rightfully so. And then all of a sudden, we'll do a little replay action here just so we can kind of relive it a little bit. Yeah, news came out. Okay, price is going to go up. I'll put my stop below some structure. And okay, good. It's going to go up. And it went down. It even started to go up, you notice. Yeah. And if I just hit play, you'll notice it all of a sudden stopped a bunch of people out, and then it went up. This is why we don't trade news. Whenever news events happen, the market makers will just mess everybody up, and they will do it quite on purpose. And they have all of the data. They know where people's stop losses are. They have more data than God. Their algos will do this automatically. So the best thing about news and macro is to know when not to trade. So sure, it's good to know what cryptocurrency is. It's good to know what Forex is, what stocks are. This is where, when it comes to knowledge, we want to be, pound smart and penny foolish. We want to make sure that we're spending more time learning what is going to make us money. Right. So it's good to have the basics of your market, and the questions you're asking are wonderful. But once we understand the market, then it is, in my opinion, time best spent to learn how to actually make money on it once we have a cursory knowledge. So Forex, it goes up, it goes down. News will make it go crazy. Manipulation will make it go crazy. So when there's news and manipulation, we avoid the trade, right? And when there isn't, then we have technical information that can help us predict up or down. And even though a lot of that technical information might be sentiment based on macro and market data and what's going on in the world, the charts are going to tell us what we need to know, even in that respect, right? So in a sense, what's crypto? Who cares? Is it going to go up or is it going to go down? What stock is this? What's the P&E? What's this? What's the metric? Who cares? Is it going to go up or down? Now, the trick with stocks is that you have calendar events. So you have, and there's, with every market, there is a level of this. With stocks, though, you have splits, you have earnings that come out, you have options expiration dates. So stocks have a calendar that you must understand. Some of them have dividends that can kind of have a different effect, or maybe something's going to change about their dividends. So it's if you're going to swing trade stocks, it is helpful to understand what's going on with that particular stock. Right now, I will trade Forex, but I tend to just trade the indices. I trade the NASDAQ right now. The NASDAQ is a group of 100 stocks. They're tech-based. It's where most of the volatility is consistently. And it does help to know what's happening in the whole market. For example, if there's news or there's this, that, the other, I do get a cursory sort of understanding of what's happening in the market. You'll see me post things in Algo Factory. We're seeing this move and that move. I think it's institutions doing this and that. So, for example, last week we saw on Thursday this big move up, which doesn't look big on this screen, but it was very big for one day. And then the following day, we had the big move down. And then, of course, today we're having these moves down. Well, the move up, I can predict that just looking at the charts. But it does help to understand that we're in a time of, first of all, it's August. It's a slow month. Secondly, a lot of the large players are actually pulling money back away from the market. So the moves that we see are sort of these technical squeezes that happen in the options market. But even that is measurable by looking at the chart. Now, I would not swing trade the NASDAQ, and I would not swing trade stocks. And the reason I would not do that is because you can get yourself in a trade on Monday morning or Tuesday morning, and then Tuesday afternoon, President Trump says, "Oh, we just made a deal with Iran," and everything goes against what your plan was.
Yeah.
This doesn't really happen with day trading. It's not as strong an effect on the Forex markets for swing trading. Forex swing trading tends to insulate you from those problems. It will cause problems day trading Forex, but this is not you. You want to swing trade. So swing trading Forex is actually kind of, as a buddy of mine says, a safe his safe place or his safe space. One of our clients who actually has family not terribly far from where you are. He's got roots in that area. The point though is that when you're swing trading, the moves are in a higher time frame. So you're predicting things that are going to happen over a period of days. So one swing in one direction, you should have enough insulation leading to your stop loss to keep you from being stopped out on such a swing. Now, you're going to tend to hear big news when it happens. When the news is big enough to affect a trade like that, it's not very common. So it sort of just gets factored into, how often you win or how often you lose.
Mm-hmm.
So that's the Forex swing trading is great. Crypto swing trading, if you're trading Bitcoin or another major crypto, it can be really good, but you'll notice this is a very ugly chart. If you'll notice it doesn't move, it's organic more or less, but you have, there is not a flow to it. It's very wicky. There's all these wicks, lots of jerky moves up, jerky moves down. Crypto can be like that in general, but the problem is Bitcoin right now, and this might be a good time to talk about crypto and Bitcoin, it's in the throes of an oncoming bear market that happens every 4 years, right? So I think what we'll do now is discuss cryptocurrency. What is it? Cryptocurrency is it's an electronic medium of exchange, and there are many different kinds of cryptocurrencies. It tends to be just basically a ledger, right? Well, most mediums of exchange are effectively a ledger, but cryptocurrency is almost purely a ledger, right? So gold in and of itself, there's not a ton of value in gold. There are some industrial applications for gold. Mostly there's just jewelry and store of value. That's what gold really is. If you take away the very few industrial applications of gold that we know of right now, of course, we might discover something in the future. It's neither here nor there. At this time, most of the value of gold, like I would say, I'm just going to say 90 some odd % of the value of gold. And I'm just pulling that number out of my hat here, but it's almost all as a store of value. We know that gold is worth this many, dollars or this many pounds. We know that's the value. So you can hold your gold. An ounce of gold is always an ounce of gold. That might fluctuate in terms of dollars, but it's a store of value that tends to go up over time. So effectively, it's going to be a ledger. Effectively, you can take your gold anywhere and get currency, pounds or dollars for it, right? Well, this is the same with cryptocurrency. It's much more risky. It depends which cryptocurrency you're using, and that's all really a matter of debate. So that cryptocurrency is just a ledger. It's all it is. It's a ledger. And it's an immutable ledger. So far, no one's cracked Bitcoin. No one's been able to change that ledger. So basically, Bitcoin is like, it's effectively a store of value. And when you give a certain amount of Bitcoin to somebody, it's put on the ledger, and there has not been anybody so far who's been able to crack that. Right? That ledger is immutable, and it's secured in this case by what's called proof of work, where several other computers will all agree on the transaction, and it's all backed by cryptography. And then Bitcoin is introduced into the market every time there is a transaction. So every time Alice pays Bob, then let's just say 0.08 Bitcoin gets sent from Alice to Bob. A very small amount of Bitcoin is created for the computer that did the work to make that transaction happen. And that transaction happens by solving a cryptographic, like a cipher. And that work that went into it costs power. But because they're using that to secure the network, and all the other computers will then agree with that, the work was done, and a little tiny bit of Bitcoin is given to the computer that solved that code. And this is how new Bitcoin is created. Now, every 4 years, and that's called a mining reward. So it's the crypto miners that do that mathematical solving that creates the transaction and puts it on the ledger. And the miners are rewarded with a small amount of Bitcoin. And every 4 years, that reward gets cut in half. So if I were to zoom out, you'll see that every 4 years, it actually does something to the price. There is an amount of scarcity that is created because of this halving event. Let's look here. So you'll notice that, let's delete this. I'm going to change this to a logarithmic chart so it's easier to see the ups and downs of Bitcoin. Okay. And I'm going to put on the halving events. There's an indicator. I could just simply type it in. And it's going to tell us when the Bitcoin halving happened. Halving cycle overlay. All right, let's do Bitcoin halving events. So these yellow lines are the halvings. There have been 4. And you'll notice the price goes up leading to and after the halving, and then it kind of goes down. And then it leads up again to the halving, finds a new low, leads up again to the halving, finds a new low. Okay. So what's going on here is that the miners understand that there will be less and less Bitcoin introduced into the market because the amount of rewards that they're getting gets cut in half. So it used to be that you got, I don't know what the numbers are, we'll make it up. Let's just say you got 10% of a Bitcoin in the early days. Every time your computer, it was just computers back then. You didn't need these powerful miners, and that's a whole nother story. But every time that happened, you got 1/10 of a Bitcoin. Well, after 4 years, you only got 1/5 of a Bitcoin for your work. And after another 4 years, you only got 1/4 of a Bitcoin. And there are a lot more factors to this, but this is a form of scarcity because there will only ever be 21 million Bitcoin. And this approaches asymptotically that point. So when let's just say you're 10 feet away from a wall, and then you're going to go halfway there. Now you're 5 feet away from a wall. Halfway, you're 2.5 feet, and then you're 1.25 feet, and then you're so you're never going to get to that wall, but you're always going to get infinitely closer. And so that is how Bitcoin's supply works. When you cut the supply emission in half every 4 years, then less and less Bitcoin goes into the market, and therefore that scarcity creates more value for Bitcoin. As long as Bitcoin is used, as long as Bitcoin is popular, as long as people like and trust Bitcoin and prefer it over other cryptocurrencies, then as long as there is a demand for Bitcoin, the amount of new supply going into the market decreasing creates an escalating demand. And this is why you see the price going up and up and up to each halving. And then after a while, due to technical reasons, after the halving, you get a top, and then price kind of goes down. And if I were to zoom in on the most recent top, you can see it in action. So we had this halving, right, that happened back in May of 2024. And you'll notice that price went from at the bottom prior to that halving, that bottom was 15,000. It went up to about 126,000, and now it is down to 60,000. It's effectively cut in half since the top after the halving that happened, right? What happened on the prior halving? Well, the bottom was at about 3,100 or so, and it went all the way up to about 70,000, right? And then after it hit 70,000, it went back down to about 15,000. So you have this wave that happens. And if we were to just kind of look at this, do some measurements, and let's just say that Bitcoin behaves as it has in the prior halvings, and there's not a lot of data. It's kind of a new thing. So we don't know that what I'm about to say is going to happen. But the math says that Bitcoin would, again, given that the whole landscape and everything else is relatively the same, Bitcoin should go down to like just below 30,000 and probably in November. That's probably what's going to happen, right? And until that happens, Bitcoin is going to be sort of choppy. There's not a lot of volume, and that makes it very difficult to trade. It gives it that ugly chart look that we were just talking about earlier, right? So to understand cryptocurrencies, to understand those basic ups and downs, the basic structure of the market, and to know that every other crypto follows this Bitcoin halving cycle. Now, a lot of people are claiming that, okay, now the institutional money is in Bitcoin, the large companies, the hedge funds, the asset managers are all owning bits of Bitcoin. A lot more money has gone into it, so we're not going to see as big of a sell-off. It's not going to go down its usual 75 to 85% after the top, right? So each one of these moves down from the top to the bottom was roughly 80%, which is why I get this $30,000-ish, $25,000 figure. If it goes down 80% like it always has, then you're going to see about $25,000 to $30,000 value Bitcoin. And it usually takes about 400 days after the top. That's just how it's gone every time. But we only have 4 times to look at, really only 3 times to look at. And 3 data points a strong thesis does not make. So, we must understand that we're operating on very little data on a very quickly changing landscape, but it is the data that we have. And all other data that we have is either extremely high level and very squishy, or there's some magical data that is not squishy, of which I am not aware, and I honestly think doesn't exist. So that said, until we see the end of this move down, we're not going to know when it happens, and that's always as it is with trading. But we are at a time when it usually goes down for a period of time, and it usually goes down about 80%. So because of this seasonal nature, and it's a 4-year cycle, so everything is seasonal, but it's usually on the seasons are annual. You have, kind of a crazy, like January kind of in stocks oftentimes is a little more money goes back in. You get a sell off after Christmas, and then you start to see a little more money come in. And then there's the Ides of March, which stock markets can often be very volatile and even sell off a little bit. And then you have a run up into May, and then you have sell in May and go away. And then the market kind of goes down for the summer, which is what we're seeing. And then you have maybe like a nice beginning of September, and then you have an October take back. So you have this sort of, you kind of know the general trends of the market, but that's an annual cycle. So you might have some months where it's some kind of tradable, kind of not tradable. There are other cycles, but with a 4-year cycle with crypto, this does introduce these long periods where trading is not quite as consistent. You have these strong moves followed by nothing for months, and then these strong moves followed by nothing for months. So it's very difficult to build a technical trading plan based on something that is inconsistent, something that has jerky moves, that doesn't behave the same way cycle after cycle, year after year. You are analyzing data from the past to create a way to trade in the future. You want the data from the past to be a bit more predictable. I can trade Bitcoin because that's how I started. I understand Bitcoin, I know how to trade it, and most importantly, I know when not to trade Bitcoin, right? So, I have a history of calling Bitcoin pretty well. I did get one thing wrong on the macro. When the last halving happened, I thought we were going to see a much grander pullback before the move up, and we did not. And that's the first time that's ever happened. But hey, mistakes get made. We operate on the data we had before, and something different might happen. So there you go. All of that to say, I don't feel that trying to become a technical trader with cryptocurrency is going to be the most stable route. What I like with cryptocurrency is to look for that cycle bottom and then maybe make some macro purchases around the time that I think that bottom is in, perhaps October, November, and then maybe hold on to it through what should be the next top, which is a few years later. That's the way I like to treat crypto. And then crypto is also good when it's volatile. So if you have like a very strong volatility macro, you can get into that. But that, this is not consistent. Most crypto traders I know, most traders are not successful. Vast majority of traders fail. Crypto traders, in my opinion, fail the most. People haven't even, it used to be very popular. Oh, let's go trade crypto. Like back in 2017, 2018, everybody was trading crypto. That was a popular thing to do. All you had to do was just bet on the price going up. Mostly, you could maximize that. But in reality, most traders after 2018's peak happened, so it was like right about here. So after the 2018 peak happened, a lot of traders just lost a lot during this period when it was headed down because they were only Pavlovian, like, conditioned for price to go up, and they did not know how to go short, much less when to do it. They were completely on a long bias, and they got absolutely wrecked, thinking it was going to go up forever and it was going to save the world. So a lot of people, such as myself, moved on to other markets, realizing, okay, we didn't know anything about a 4-year cycle back then. People knew very little about any of it. And I moved over to Forex at that time. And then Forex was great. Like, there was plenty of volatility there for a few years, and there still is. It's been a pretty good couple of years for Forex. And then, of course, I moved on from Forex not very long ago to the NASDAQ, which I really wish I would have done ages ago. The NASDAQ, it's just one chart, and there are plenty of opportunities, and the spread is very tight. This is another thing to consider when trading is spreads. When you're trading in Forex, you have to pay a certain amount of what's called a spread. Anytime you trade, you do. It's either a fee or a spread or a combination of both. And if I were to go to a different chart, let's say this chart, you can actually see the spread. Yeah. So this is the euro versus the dollar. You see my prediction, and you can see these lines right here. I don't know how clear it is on your screen. There's a red line here, a green line there, and a blue line here. Is that visible to you?
I can't see with your cursor.
Green. There we are. Apologies. So here you may be able to see it. There's a blue line here, very faint, a green line here, and a red line there. Can you see those?
Yes, they're faint, but I can see them. Yeah,
they're faint. I can make them stronger, but we don't need to talk about this for too long. The midpoint is the price. It's the quote price. The top part is if you buy, you're paying at this price. If you go long, the bottom, the blue, is if you sell. This is the price you're entering. So you're entering below price when you sell. You're actually losing money. So when you go long, you're betting on the price going up. It's the quote you're getting is this green middle point, but you're actually buying at a higher price than that. You're paying half of the entire spread. This is why if you ever start to talk to traders in London, they call this spread betting.
Okay.
They're very, very popular. They don't say it here in America, but if you're a Forex trader, which is a very British thing to do, this is spread betting, right? Like you're going to have to pay a decent price to get into a Forex pair. Now, every pair has a different spread. The euro has, right now, it's a spread of 2 pips. And we can get into pips and stuff. That's a deeper conversation. But if you were to go to like some pair that is not traded very often, like say the New Zealand dollar versus the Swiss franc, now your spread is 6 pips. Much bigger spread. You're going to pay a much higher price to get into this trade, especially when you start to get into, well, actually, that's a pretty tight spread. Oh no, that's a big spread. This is the Swiss franc and the Japanese yen. It's 18 pips. So the price you're going to pay is like 10 times almost as much as you would pay to get into the euro. But it moves much more slowly, right? So you're putting in smaller positions to make bigger moves. And this is all stuff that is a little beyond what we need to talk about today. But if you look at the NASDAQ, look how tight the spread is. It's 16 cents. Now, 16 cents for a $30,000 asset it's a very different look than 2 pips on a $1.15 asset. So 2 pips in this case is going to be let's see, tenths, hundreds, thousand. It's 2 10,000ths of a penny. It starts to get let's just say the amount per dollar, like that you're gonna, like, for the position that you're entering into a Forex trade, you're going to pay a lot more money compared to the amount you would pay to get into, say, like if you're trading the FTSE, which is sort of the main British index, right? Or the NASDAQ, the Dow. The spreads are much, much, much tighter. You're paying a minuscule price to get into these trades that are the indices like this. So as often as I'm trading, that matters. For you as a day trader, as a swing trader, it kind of doesn't matter. And in a sense, the volatility and the headline risk of trading assets is a bit dangerous when it comes to trading like the NASDAQ or maybe the FTSE. You are leaving yourself at risk to Trump saying something. Cryptocurrency risk is going to be just that inconsistency, building a dependable algorithm on something that changes so often. Trading, like day trading the indices, you can build a pretty reliable algorithm on that, but you're day trading. So you can have, 10 trades in by the time you get the headline that ruins your trade, because you're day trading. When you're swing trading, you're going to get 1 or 2 trades in by the time there's a news headline that ruins your trade. But it's not going to ruin your trade because you're swing trading. So the swing trading is a bigger, slower move that insulates you against the headline risk. So you can swing trade these indices, but the indices move in a much more violent way because of the headline risk. So for you, I wouldn't mess with crypto at this time unless you are passionate and you really want to learn how to do it. That's another story. It's going to be your choice. Yeah. I'd say for a swing trader, Forex is probably a good place to start because you're insulated against the headline risk, and you, by the mere nature of swing trading itself, the position sizes are small, the space that price moves is large. You know when a lot of news is coming, you know when to avoid those trades. You have a life. You're not just sitting in front of the computer trading every day. Swing trading works for your schedule. Swing trading protects you to some degree, to a substantial degree, against the headline risk. It seems that that's the best fit for you based on those metrics. Now, there may be other considerations of which I'm not aware, and then, we can even talk about them now if you wish.
No, that sounds, because it all sounds very exciting. Crypto, Forex, and stocks. And I was thinking, which one? But my gut is leading me towards Forex, because I do have work to do. So I would like at some point, if I can master it, to become a day trader. But I think for now, just as I'm learning and getting to grips with everything, a swing trader sounds good. And that's really interesting what you said about the halving of crypto, because I had no idea about that. So that really has sort of clarified why, because I couldn't understand, why does it always go up and never down? And now that's illustrated.
The two reasons are: one, the halving. The second reason would be a continuous demand. So if Bitcoin were to be outmoded, or perhaps the code were to be cracked and people could cheat and steal based on just cracking the code, well, then of course the halving wouldn't matter because it's a useless asset.
Yes. And maybe for our next lesson, Nick, but I am curious what a perfect looking chart would be, because I want to again understand, if I'm going to look at the charts over the weekend and study the charts, what should I be looking for? Is there such a thing as a perfect chart? Is there a pattern that...
Absolutely not.
There's no perfect.
Nope. You will be searching for the rest of your life. What you want to avoid are things like I showed you with the USDJPY, but you will know to avoid that because you've been avoiding it. This is where understanding what's going on helps. These nasty wicks that you see on the macro, and even when I zoomed in and we saw them on the lower time frame as well. Not that this is the macro. This is actually a day. This is a swing trading time frame. We're looking at the 3-hour chart. So, have you watched my weekly video that I do?
Yes, a bit of it. Yes, I have. Yeah.
So this is a good example of how I look at a chart for the next upcoming week. And I take a look at, what it's done. Some of the what you're not seeing me do is looking at the higher time frame trend, looking at my algorithm. You will see me look at the higher time frame trend. You will, but I'll usually just talk about it. I'll say, hey, this is bullish high time frame, so price is going to want to go up. But in the meantime, we have, so if you sort of watch that weekly video, that's going to give you a feel for how one looks at the charts to judge two things. One, where is it probably going to go? Two, where are my opportunities? So, and a lot of it, and this will, there are two ways to get a good feel for this. Both of them involve time in front of the charts. Way number one, and again, you asked a question related to way number one earlier, which we have not yet addressed. So we will address this question. Way number one is building your algo and backtesting. Because what you'll do is backtesting is literally going through historical charts for hours upon hours. Now, you may do it for an hour or two one day. You do it for an hour or two after a couple days. You might do a few hours a week. Eventually, you will have gone through a certain amount of chart history, and you will just you'll just be literally looking at the charts and understanding how they work, just via exposure. Okay. The other way, of course, is osmosis, which is, these are both a form of osmosis, but that's like an inactive osmosis, or that's a little more of an active, it's not all osmosis, but it's just exposure. The other version is to continue to watch our live labs. You'll start to learn as I'd say, hey, this is doing that, that's doing this, this did that. For example, if we look at this Bitcoin chart, you can see the prediction that I made on Monday, yesterday afternoon, the video that I put out last night, and it's going to kind of grind and crawl upwards. Now, what might happen is it might reverse back down because you see price reversed 3 times at this level that is that blue line. So that blue line right there is a level at which price reversed back down 1, 2, 3 times. You could argue many more times because there are several wicks in this area, but we'll just say 3. And then you can look at the bottom and see that price reversed in this area here twice very clearly. Yes. And also in the general area numerous times, including this double bottom right here. So we know that this area down here is what we would call a demand zone, where Bitcoin comes down and people want to buy it. And this area up here is what we would call a supply zone or a resistance. Down here is a support or a demand zone. There are different words for these things. They sort of matter, sort of don't matter. Knowing that price reversed at this level, knowing that Bitcoin is at a time of low volatility, which means that it may not have the power to punch through this level. Low volatility means it's moving very slowly. It's very reactive to this structure, which when I say things like resistance and demand zone, they are the same thing. They all are also both, they are also both forms of structure. When I say support, or I say, forgive me, I just messed that up. Resistance is a supply zone. Those are both forms of structure. A support is a demand zone. Those are both forms of structure, so it's easier simply to say structure. And this structure has been defined and created by multiple rejections to the top side in a time when there's not a lot of volatility in the market. Market just kind of wags back and forth. It's not really moving hard in any given direction, and it reacts at structure. For example, we can see here that price rejected 1, 2, 3, 4, effectively 5 times, really 4, at this level. And when price tried to come break above that level once again, you see that it rejected here, even before it got to this level. So this was a prior structure at which price really did reject back downwards. And of course, we're now at our current scenario where price wants to reject at this level again. So if price were to make its way up here, which I think it will, possibly by the end of the week, then it might be a good opportunity to consider going short. That's possible. And this is why I have this short, I call these a short box, but it's really called a short position tool. So the short position tool is here because if we do get a rejection here, then we have a possible trade to the downside. So I know this because I've looked at past structure. I can see that the market is obeying structure in a very definite way. And it's safe to say that it's probably going to reject downwards. However, if it does move upwards, then it's demonstrating a certain amount of strength to do so, and therefore might move up towards the next available structure, which is this top that we see up here. And if we enter, even if we lose our trade here, if we win the trade, it's a 3.4 to 1. I've put in 1,000 pounds to pull out 3,400 pounds, or 100 pounds to pull out 340 pounds. If we lose our trade, it might even be better than that. But if we lose this trade, we lose 100 pounds, and we have the opportunity to enter this long trade should the algos tell us we can, and that's also a 3 to 1. So if we win this trade, we will win 308 pounds, and that 100-pound loss is now rendered, gone or irrelevant. You've made it up here. So we understand that in this particular market, and with Bitcoin, structure is where price is predictably going to move. And it's almost always in every market what we look at for swing trades. We always look at structure, and quite frankly, any market at any time frame, structure is very important. So this is how we assess things. Is this a perfect chart? It's a darn nice, fun chart to trade. Like, you have very clearly defined structure. You have a market, like I keep saying, that's likely to move at structure. Even if it breaks above, then we know it has enough energy to punch through and move up. So we have our opportunity on both sides of it, right? So that whole conversation that I just kind of ran through, I spoke quickly, but I repeated everything a lot. And this is how we look at charts. We look at structure, behavior, and then that's just naked charting. Then we have our algos. We have our indicators at the bottom of the screen. We match them up. We build a formula of these indicators to give us an edge that naked trading does not necessarily have.
I see.
So I can, this is a 3-hour chart. So if I were to go to a higher time frame, then I could see via my indicators on the bottom here that this is rather bullish. It's not the most bullish thing I've ever seen, but it is rather bullish. Now, it's bullish on the high time frame, but I can tell because of the way all of this looks and my experience, it's bullish, but that could change. But until it has changed, it has not changed. Therefore, we can go back to our trading time frame on the 3-hour and say, great, it's pretty bullish. So if we get a rejection at structure, we can make money here. If it punches through because it is bullish high time frame, it's just kind of weekly bullish. WEAK, weekly, not week as in 7 days. Then we, actually I think that wasn't the weekly, so it's double entendre. Then we can make money on it either way. And I know this because I have the data on the high time frame, whether I was using the indicators or not. That data is there, but I always use the indicators. So the indicators give us an edge, right? And the indicators, you'll see that we have all this data at the bottom of the screen. So the data at the bottom of the screen shows me my opportunities. And then looks like you got a siren there. Is that you?
They tend to put the sirens on. It's me. They tend to put the sirens on for any occasion. It's not necessarily an emergency.
Gotcha. They probably just want you to get out of the way so they can get home. So
yeah,
I would say, again, the data at the bottom of the screen gives us kind of an edge. We know it's going to want to go up or not. And then the structure for us is going to be one of two things. It's going to tell us when to enter for a short, or let's say when not to enter for a long. Let's say all of the data says price is very bullish, but you're coming up to a place where it's going to want to reject to the downside. Then we do not consider a short. We only consider the breakout and we ignore the short. You see, so if we have this data with the indicators telling us the price really wants to go up, then we don't want to bet on price going down, but we cannot bet on price going up until it has cleared the structure. You see, so there it's a form of filtration. It's filters. We call such things filters, right? So you have reasons to get into the trade, and then you have reasons not to get into the trade, and all things must line up to get into the trade. And this is way beyond where you're at, but it's a preview. So at this point, I'm not sure exactly where you are in the education. It's good to get this fundamental understanding of market structure down. If you do not understand market structure, I don't care how good your algo is, you're probably going to have a problem. And there are ways to code structure in. I tend not to do that. I tend just to have an algorithm and take the losses, but there are recent advancements have made it a lot easier to code structure into your algo. If you want to make a coded algo that trades for you, and so on and so forth, but at least understanding the market structure is just key. You just have to know how this stuff works. And again, you just take your time with it. What I would do is go ahead and you might use AI or internet search for. Here, I'll give you a little bit of a clue, and it's in the courses. But I like to try to use indicators that use different math, or as you would say, maths. Okay. We don't pluralize math in the U.S. So
yes, we do.
I would say, for example, your MACD is a very typical. And I use it, and I use it in its basic form too. I used to change things. Sometimes I still do to change the settings, but compare MACD to the RSI, two very basic, very common indicators out there. The maths are very different on those two. So, for example, if you have two different people who have two different frames of thought and they're pointing in the same direction, then they're gathering data from two separate areas and they both agree on something, then chances are they're going to be right. Or at least the chances are better that they're going to be right. So we want to use indicators that have different math. And if indicators that have different math point in the same direction, then you have a higher likelihood of being correct. So you don't want to use the stochastic RSI and the regular RSI. They're both RSI based.
Yes.
So what I would do is, and don't worry about getting it right. But once you're ready, once the time has come that you've gone through enough course of the coursework to start building an algorithm, this is what I tell customers. Don't worry about doing it right. Just worry about getting it done. Don't even worry about it being terribly profitable. What you want to do is just play in the sandbox, put together an algo. You can go to your AI search, whatever it is, say, give me 3 fairly common trading indicators I can find on TradingView that all use different math to each other, and then try to build an algo with it. And get through, build the algo, get through 20 back tests, right?
Yes.
Once you've gone through 20 back tests, whether you're profitable or not, just let me know. And then we have our first private one-on-one. Now, it doesn't have to be private. We can do it right here. for everybody to see, which probably would be really cool. But if you prefer to keep it to yourself, we do have the 2 private one-on-ones that come with your membership as well. I have people who do all of their training on the public. They just don't care. And no, trust me, I've given away enough on my channel for anybody to just go through and learn how to trade. This is people, you could give people your algo. They're never going to get it right because they don't go through the rest of the course. So I would say we'll do this every week. Don't get me wrong. So I'm happy to guide you through. This is really fun to do. And it's helpful. However, you'll want to build the algo, even if it sucks, and just get through 20 back tests.
Okay. Yes.
And then what'll happen is I'll talk to you. We'll take a look at what you were doing, and I'll probably find some areas where we can kind of put you in a productive direction. You may start over, and that's fine too. It's very common. First algo is just like, the first of a lot of things. You're just giving it a shot. You're just getting used to, the mechanics.
Yes, of course. That's good. That's a good idea. So I'll look at 3 common indicators on TradingView to see if they kind of cross over or align or show me something that they agree on. That makes sense because there's so many indicators. I'm not sure which one, but now that's made sense. It doesn't seem wise to use indicators that are similar because they're going to record similar information. Got it.
10 sets of 3 indicators, 3 trading indicators that I can find on TradingView that have different mathematical family. Let's just say mathematical inputs. I want 10 sets of 3 where their maths are as different to each other as possible while being fairly common indicators. All right, let's see what that says. So it's telling you literally what I said. To build statistically independent setups on TradingView, you want to combine tools across fundamentally different mathematical models, right? So you have simple moving average, relative strength index, on balance volume. So that's kind of, these are the ones that like a lot of people use, right? Although I haven't used OBV a lot, but that's fine. I avoid volume, by the way, because Forex volume is wishy-washy a little bit. The Forex brokers are decentralized, so volume is not consistent, right? If you're using the same broker, it's going to be consistent for that broker. You can use volume, but I don't even include that much volume very often in my stuff. If I were using trading the NASDAQ, it's a different story. It's all based on the CME and so on. So set 2, you have Bollinger Bands, stochastic oscillator, volume profile. I do use the volume profile. That's actually usable. I use it a lot, but I use a different volume profile. I use a fixed range. Another story. Set 3, true range, ADX, volume weighted average price. Right. So these are all just different ideas, and you could just kind of play with them. And what I will do is I will copy this output. And, by the time you've tried it out, I might be like, I don't like that. I might give you some feedback by then of, maybe don't use that one, maybe use this one. And, what usually happens in those scenarios is you've done the work enough to understand the process, and therefore I can kind of step in and give you some more functional ideas, right?
Yeah.
So let me find the Telegram. What I need, or I should say what you need, is just get your hands in the clay.
Yes.
So where's Natasha? There you are. Okay. Okay, so I've thrown that readout in your Telegram, so feel free to kind of use that as a place to blast off.
Yes, excellent. That's very helpful, and I think it's starting to, as I said, bring sunlight to that foggy place. So that's really good. So I think so. I'm still. I went through the course once, and now with a bit more understanding of the terminology, I'm going back over the course again slowly, and I'm understanding different candles, because I want to try and work out maybe 1 to 3 formulas that I would like to test and, back test. That makes it comfortable. I have one at the moment, but as I said, as I'm going back through the course, things are kind of sparking for me slowly.
Well, at some point, just pick 3 and go for it.
Okay.
20 back tests will not take you very long.
Okay.
Just at some point, take 3, go for it. It very, very, very likely will not be the 3 with which you stick.
Mm-hmm.
We just want to get you into the process rather than, trying to go for the kill shot.
Yeah, absolutely. Like, I want to do the practical. I have a bit of theory, but the practical, dirt under the fingernails, as you said, hands in the clay, is most important.
Perfect. Well, it has been a pleasure, and thank you all for watching. Natasha, thank you for giving us your time. And
thank you so much.
Any kind of last bits before we take off? Any last questions there?
No, everything's kind of percolating in my brain. However, I may have a question for next week's lesson, but I'm going to just take on board what you've said, get my hands in, and then I'll pose that question to you in our next lesson, Nick.
Okay, perfect. Yeah, it's a Rubik's Cube. After you play with it long enough, it starts to talk to you. So
yeah. Excellent.
Lovely.
Thank you so much.
Thank you.